Hey, what is poppin', guys? We do not need a great memory to recall the last real estate bubble. Just 10 years ago, an implosion in United States housing market and several other around the globe captured the world into the worst financial crisis since the Great Depression. So, in this video, I will explain how to spot a real estate bubble. In 2008, when housing bubble burst, S&P 500 lost half of its value. Unemployment rate doubled, several investment banks were forced to disclose or merge in order to survive, and millions of Americans were foreclosed and lost their homes. It's no wonder then that homebuyers and others, especially in areas in limited housing supply like Silicon Valley, San Francisco, Los Angeles, and New York City, may be nervous about the next real estate bubble as home prices are rising and buying home is generally the biggest investment that Americans make in their lifetimes. Though there is no ideal way to spot the real estate bubble, and experts do not even agree on whether one can be identified or prevented. There are a number of indicators that homebuyers and shoppers can follow in order to determine the likelihood of the bubble. Those indicators include low interest rates, how rates tend to fuel bubbles, home price indexes, a measurement of housing prices of single-family home in the given location. Those offer the easiest way to follow the rise and fall of home prices. Price-to-rent ratio, which is the ratio of the price of the home to the annual rent that it would generate, the measure of affordability of renting versus buying. Lower ratios indicates that buying is cheaper, while higher ratios would signify that renting is the better deal. Price-to-rent ratio tend to rise during the bubble as speculative interest in home buying lift the home prices. Determine to what extent rising prices are being driven by speculators rather than residents, as housing bubbles tend to be driven by speculators or investors who are buying homes to turn a quick profit rather than living them. What is real estate bubble? A bubble is simply a sudden escalation in price of an asset class, such as we have seen with cryptocurrency back in 2017. The term is often used when the rise in prices is diverged from its underlying value of the asset and followed by rapid decline. The bubble is so named for its appearance on the chart as the asset price suddenly rises and then falls, creating the rounded shape of a bubble. A bubble often emerges from the supply and demand becoming imbalanced. When demand for housing exceeds supply, which mostly often happens in the cities with geographic boundaries like San Francisco, Seattle, or New York, that have booming economies, prices tend to escalate. Speculators and other investors may see opportunities buying houses in order to turn a profit rather than living those homes, a process sometimes called flipping. Eventually, the imbalance tends to correct itself as higher prices drive down demand or supply catches up with the higher level of demand through new construction. In real estate, bubbles take place in housing market, commercial properties, or simply land, and all have been popular target for speculators all over United States history, since there is a constant need for real estate and housing. Banks are generally willing to lend money for real estate and housing purchases, and its high value can allow for large profits. According to International Monetary Fund, real estate bubbles are less frequent than equity or stock market bubbles in general. Real estate bubbles occur every 13 years on average, but last twice as long as stock market bubbles last. Real estate bubbles also lead a double to loss in output of 4% decline in gross domestic products caused by equity bubbles. GDP is defined as the total value of all goods and services produced by country or similar entity in 1 year. In today's market, when investors refer to real estate bubbles, they generally talk about the housing market, as that was the most significant driver of the last real estate bubble as well as financial crisis. This is the reminder of the biggest concern for home buyers today. The local effect. Unlike equity bubbles or cryptocurrency bubbles, real estate bubbles tend to be localized, as the real estate market differ wider from city to city. For example, recent real estate bubble was much more extreme in markets such as Florida and Las Vegas, that we have seen fast growth or where housing was already scarce. Such parts of the country have history of real estate speculation and have long been attractive destination to Americans from other parts of the country. Another key question to ask is whether rising real estate prices report a housing bubble or just strong housing market. In tight market, housing prices can grow faster than the rate of inflation, but that does not mean that bubble is being created. For example, in Manhattan, the median home price has risen steadily from $400,000 in 2000 to $1.3 million in March 2018. Though prices pulled back about 15% during the financial crisis. The San Francisco market has seen a similar appreciation, rising from a median home price of $415,000 all the way to $1.35 million, and saw a similar modest pullback during the financial crisis. Both markets have boomed for similar reasons. They have geographic construction that naturally limit the housing. Manhattan is an island and San Francisco is peninsula and home to booming, high-paying industries such as finance, banking, and media, and others in New York City, and tech in San Francisco and other surrounding Silicon Valley. In San Francisco, housing prices have doubled in the last 6 years as the mobile economy has heated up. Because both of those cities have high demand for housing, the real estate market should avoid a bubble as long as the local economy remains strong enough to support the corresponding home prices. For homebuyers trying to measure the strength of the local economy, some key indicators to watch out for is the average household income, population growth, and local unemployment rate. Demand for housing can also help shed light on the strength of the housing market, as housing inventories, measured by the number of months the average house stays on the market, is one of the best indicators for housing demand, along with home prices themselves. If inventories levels are near or below their historical average, that indicates that housing market is solid, as demand is keeping up with the supply. Let's look at some key questions homebuyers and investors should ask to determine whether their cities are in the real estate bubble. Number 1. What are the mortgage rates and where are they going? There may be no important factors to influence home prices than interest rates. Low interest rates encourage homebuyers, as most homebuyers use mortgage to buy a new home. The lower the mortgage rate, the less the actual cost of their monthly payment would be, effectively making the home cheaper to buy for them. Though a mortgage rate does not directly affect the price of the home, it does affect the cost of the buyer. Higher interest rates, on the other hand, tend to cool off the housing market, as they make buying a home effectively more expensive. Let me give you an example. $500,000 mortgage at 4% over 30 years would cost just $2,387 a month, while the same loan at 7% would cost nearly $1,000 more per month, which is $3,327, meaning the borrowers would pay $300,000 more over the lifetime of the loan. Consequently, interest rates have direct effect of the housing market, as low rates will encourage buying, which can increase housing demand, leading to decreasing housing supply and eventually higher prices. Therefore, real estate prices are most likely to go up when rates are low or falling. while raising rates are likely to tide the market or cool off home buying. Assuming all other things remain equal, mortgage rates vary depend on the lender and the borrower, but according to Bankrate, the lower available rates for 30 years fixed mortgage, which is the most popular type in the United States, is currently at 4.375%, while that is up from the modern era low of 3.31%. It is significantly below the average of 8.2% since 1981. Rising mortgage rates will likely cool off the housing market that also bring housing prices down. During the housing bubble of the decade ago, mortgage rates were lower than average, wiggling around 6%, but is still above today's low. In other words, low mortgage rates can encourage a bubble like the atmosphere, but it is just one of the many factors that can come into play. Some analysts believe that rising mortgage rates have encouraged buying as homebuyers want to lock in low rates while they still can. If that proves to be the case, higher mortgage rates will eventually cool off the housing market. The effect of rising mortgage rates will just be delayed. So, we came to the end. Let me know what you guys think about the current housing state. Are we in the housing bubble or not? Leave your thoughts in the comment section below. If you enjoyed this video, hit that like button. And if you're new to this channel, do not forget to subscribe for more animated videos about financial market and cryptocurrencies. Other than that, thank you for watching and see you next time.